Now, this is probably one of the more important issues. When you start your retirement is actually a critical time. This is unfortunately one of those issues. I know, Alan, you and I have talked about this with Paul Cludeau and others. Timing the market is one of the hardest things to do, and we generally recommend people don't do it. Unfortunately, when you're in retirement, market timing does become important. This is the one stage in your life when investing at the right time and making sure you're in the right assets at the right time is much more critical. There is no easy way or no easy answer as to how you do that, but we do say you do have to be more cognizant. You want to be in defensive assets when markets are looking bad, and you want to move back to growth assets so you can beat inflation when markets are looking better. And I want to illustrate that with the next slide. So this is a picture. This is assuming that you had $1 million when you retired, and you started your retirement in 2008, and you're withdrawing $50,000 a year. So after 30 years, you'll end, this is 20 years, I beg your pardon, it's 20 years. After 20 years, if you started in 2008, you would end up with $1 million balance, which you think, well, that's all right. I mean, it's not too bad. If you had started the same process a year later, so in 2009, so you're starting at the bottom of the market, you're now investing in equities, your outcome is substantially different. You're almost $2 million better off. And that's largely because you're buying equities. And this is assuming you're 100% invested in Australian equities. This is the ASX 200 accumulation index. You've only got Australian equities. This would be the difference. Now, this is an extreme example of how market timing can affect you. So what we do say is make sure you have a balanced portfolio, and you want to be balanced between defensive and growth assets, and shift that balance over time, depending on how markets are, but also depending on where you are in your retirement life cycle. And we will touch on this topic again and again. I'm planning to write, I don't know, Alan, if you've read some of my diaries of a self-funded retiree. I have another one coming up, which will touch on this topic.
I can't wait.
I know you're an avid reader, Alan. Thanks.
I am, indeed.
And this is really designed to this is a critical issue. And as I said earlier, there's no easy answer. I mean, I've been in the markets 35, nearly 40 years. I have met very few people who are good at timing markets. So it's
the problem. The basic problem is that when market's expensive, when the market looks expensive, and everyone tells you it's expensive, that's the time to to not be there. But the trouble is that markets, when they're expensive, can get more expensive.
As we're looking at right now, Alan.
That's right. So at the start of this year, I would have said the markets look expensive, but then they've got more expensive.
They've got more expensive. So they really. So I think, as Alan and I both agree, this is a very difficult issue. We'll try and help with some more detailed tips in one of my future diary entries. What can you do? You can make sure you're in a balanced portfolio. And, you don't want to be 100% equities. You don't want to be 100% fixed interest. And it's just how you move that balance from 60-40 to 70-30 to 70-30, 70% defensive to 30% growth, from 70% growth to 30% defensive. That, how would you move that? The only other thing you can do, which we do encourage people to think about, and certainly what I think about, is this assumes an annual drawing of $50,000 a year, no matter what the market conditions are. If you can provide flexibility in how much you spend money, so you can turn off some things you spend money on and turn them back on again, depending on how markets are, it is sometimes much easier to adjust your spending to fit market conditions rather than try to adjust your portfolio to fit market conditions. But it's food for thought. As I mentioned, there is no easy answer. But it is one of the big issues which all Australians are facing, because we all have the same issue that, we have a savings pot, which the government in their foresight has encouraged us to create. What they haven't done is try to solve this issue about, what do we invest in to make sure it lasts for as long as it can without us having to adjust our lifestyles too many times.